Hi there traders, this is a sixth video devoted to the futures trading course by the C-Scalp. In this video we will talk about how to avoid liquidation, how to calculate your risks, and calculate the profit and loss per trade. If you missed some previous videos, you can watch them by clicking the link under this video. Subscribe to the channel and we go to the topic. The main risk in futures trading is to incorrectly predict the price movement and close position in loss. From this risk comes another one, more tangible for any trader, not to close the position in time and get liquidated. Usually it happens due to emotional trading. Liquidation is a process of closing a position by the stock exchange when the exchange sees that the market went against our position and burns most of the margin. It forcibly closes our position to avoid losses. If we trade in the isolated margin mode, then when we liquidate our position, we will lose only the amount that we have allocated to secure the position. This is a relatively painless option, especially for beginners. Futures trading in the cross-margin mode is much more risky. In the cross mode, the funds securing the position are all the free funds in your account. So you can lose all the funds in your account by only getting more and more loss in only one position. Another risk is to miscalculate the profit on futures trade or loss. The trade may go well, but due to incorrect calculations, you can go into minus due to commissions. Let's understand more about how to ensure a futures position and how to correctly calculate the profit on futures position and loss. Here we need to give some examples from my personal experience, what you should follow first of all. First of all, choose the right leverage. How to do it, you can watch in the previous video. Trade with a comfortable volume. Always trade with a comfortable volume, otherwise you will feel uncomfortable in your trade and probably you will make wrong decisions. Use isolated margin, especially if you are a beginner, and use cross-margin mode if you have a lot of experience in futures trading. But anyway, keep in mind the risks involved. And of course, you should use stop loss, keeping in mind that they are executed by the market. Let's see how to calculate loss or profit using the first method. Let's imagine we have $100 deposit and we trade with 10x leverage. Our position will be $1,000. So $1,000 will be our entry position. We bought altcoin futures for $1,000 and we expect to get 1% of movement. So we calculate 1% and there will be $10 of profit. This is quite easy to calculate, but we forgot about the commissions for entry and for fixation. So we remember that our profit is $10, but we should deduct the commissions. So we go to bybit trading fees website, and here we see that non-VIP user maker fee and taker fee are absolutely the same, 0.1%. So to calculate the commission, you should multiply this parameter by your position volume. Maker and taker commissions are the same on Bybit, but they differ on Binance, for example, by 2 times. When you enter market by limit order, you are maker. When you enter market by the market, you are taker. So in this case, the commission is absolutely the same. To calculate this commission, we multiply 1000 by 0.001. So we have $1 commission from the entry when we enter the market with $1,000 by the market or by the limit order, we pay $1. And we also pay $1 when we fix this position. So we remember our $10 profit. So we deduct $2 from this amount, and our net profit finally $8. But that's much more important to be able to calculate your risks, your potential loss. For example, we are trading the pullback from limit order. We are trading, we are scalping the pullback from huge limit order, and we calculated that our stop loss is about 0.2%, so we should calculate our potential loss. We multiply 1000 to 0.02, it will be 0.2%. We will get $2 plus $2 for $1 for entry and $1 for fixation. Finally, our potential loss will be $4 in total here if we have a stop loss hit. But we should take into account that if we have $4 loss, we should have the profit at least 2 or 4 times higher. At least, for example, $16 as we usually have in scalping. In this case, when you have potential loss of $4 and potential profit of $16, it will create positive mathematical expectations, and in long run your deposit will grow. It's extremely important. Another one really useful tool is bybit calculator. We go to USDT partial, and here we see the calculator. Let's imagine we will trade BTC. We use 10x leverage, enter quantity of BTC. Let's imagine we want to open the position for $5,000. We divide $5,000 by the current price. It will be 0.11 BTC, and entry price will be the current price. And let's calculate our stop loss. Let's imagine it will be somewhere here on this zone, 43,478. So we calculated that our initial margin will be 481, and our loss will be, in case of stop loss hit, will be $29. It will be 0.6% stop loss. Okay, and what about our potential profit? We are expecting the over high of this, of the previous maximum. Let's imagine our take profit will be 44,750. Our profit will be $110. The risk reward ratio is quite good, 1 to 3. That's how we can calculate our loss or profit, depending on what we trade, long or short, and it will be calculated for you automatically. To calculate the margin that is used as a collateral in your trade, we just divide the amount of our position, $1,000 for example, by the leverage used. For example, we use 10 leverage, so our margin will be $100. That's quite easy. I hope this video will help you to trade with more efficiency, and now you know how to avoid liquidation and how to calculate potential loss and profit per trade. In the next video we will be talking about fundings and how we can use it to our advantage to make some profit. Thank you for your attention. See you soon.